Ethics is a term that refers to a code or a moral system that provides criteria that evaluates right and wrong. One characteristic that distinguishes a profession from other occupations is the acceptance by its members of a responsibility for the interest of those it serves. Ethical behavior is expected of those engaged in a profession, and that expectation often is articulated in a code of ethics. So, for example, laws of medicine are professions that have their own codes of professional ethics. The AICPA, the National Organization of Certified Public Accountants, has its own code of professional conduct that prescribes the ethics that members should conduct. And the Institute of Management Accountants, the IMA, which is the National Organization of Accountants Working in Industry and Government, has its own code of ethics, as does the Institute of Internal Affairs. Ethical codes are informative and they're helpful, but the motivation to behave ethically has to come from within oneself and not just from the fear of getting caught if you do something wrong. So, as you'll see in this slide, there's a sequence of steps that provide the framework for analyzing ethical issues. And they can help you apply your own sense of right and wrong in determining ethical dilemmas. First of all, determine the facts of the situation. This can involve determining who, what, where, when, and how. Step 2 is identify the ethical issues and the stakeholders. Now, the stakeholders could include shareholders, creditors, management, employees, and the community. Step 3 would be to identify the values related to the situation. So in some situations, confidentiality may be an important value that might conflict with the right to know. Step 4 is specify the alternative courses of action. Step 5 is evaluate the courses of action specified in Step 4 in regards to the consistency of the values that are identified in Step 3. Now, this step may or may not lead to a suggested course of action. Step 6 is to identify the consequences of each possible course of action. If Step 5 does not provide a course of action, assess the consequences of each possible course of action for all of the stakeholders involved. And then finally, Step 7 is make your decision and take any indicated action. So ethical dilemmas are presented throughout this course. The analytical steps outlined here provide the framework you can use to help evaluate the situations. Which of the following is not one of the ways in which high-quality accounting is encouraged by the United States financial reporting system? Would it be A, accounting standards encourage comparability? B, auditors assess whether financial statements are materially misstated? C, Sarbanes-Oxley instituted reforms designed to improve the quality of financial reporting? Or D, managers are required to use frameworks for ethical decision-making when deciding how to account for transactions. So I'll let you take a minute to decide which of these would be the correct answer. The correct answer is D. This is not one of the ways. Ethical frameworks can be very useful, but managers are not required to use them. Sturdy buildings are built on a sound foundation. The U.S. Constitution is the foundation for the laws of our land, and the conceptual framework has been described as an accounting constitution because it provides the underlying foundation for the U.S. accounting standards. The conceptual framework provides structure and direction to the accounting and reporting of financial information, but does not directly prescribe GAAP. It's a coherent system of interrelated objectives and fundamentals that's intended to lead to consistent standards that prescribes the nature, function, and limits of financial accounting and reporting. The fundamentals are the underlying concepts of accounting that guide the selection of events to be accounted for, the measurement of those events, and the means of summarizing and communicating them to interested parties. The financial statements and their elements are most informative when they possess specific qualitative characteristics. Proper recognition and measurement of financial information rely on several assumptions and principles that underlie the financial reporting process. So the objective is to provide financial information that's useful to capital providers. The rest of this framework is explained in detail coming up here. What characteristics should information have to be best to meet the objectives of financial reporting? Well, this slide shows the desirable qualitative characteristics of financial reporting information, presented in the form of a hierarchy of the importance of these various characteristics. They're intended to enhance the decision usefulness of information. Relevance in the context of financial reporting means that information has predictive value and confirmatory value, hopefully both. So examples would be current period net income has a predictive value if it helps users predict a company's future cash flows, and it would have confirmatory value if it helps investors confirm or change their prior assessments regarding a company's cash flow generating ability. Financial information is material if omitting it or misstating it could affect users' decisions. The threshold for materiality has been left to the subjective judgment of the company preparing the financial statement and its auditors. So basically what that means is it is considered material if that change in information would alter the decision-making of the stakeholder. So if the number would be changed and that would alter a creditor from lending the company money, then it would be material. Faithful representation exists when there's agreement between a measure or description and the phenomenon it purports to represent. So faithful representation is enhanced by completeness, neutrality, and being free from error. A depiction of an economic phenomenon is complete if it includes all the information necessary for faithful representation of the economic phenomenon that it purports to represent. A financial accounting standard and the standard-setting process would be neutral if it's free from bias. It should not try to be focused on a particular social outcome or favor particular groups or companies. Representational faithfulness also is enhanced if information is free from error, meaning that there are no errors or omissions in the description of the amount or the process used to report the amounts. As you see, there's also some other qualitative characteristics that enhance usefulness. Comparability helps users see similarities and differences between events and conditions. Consistency refers to the same accounting practices being used over time to permit valid comparisons between reporting periods. Verifiability implies that different knowledgeable and independent measures would reach the same regarding whether information is a faithful representation of what it's intended to depict. Timeliness indicates that information is available to users early enough to allow them to use it in their decision-making processes. And understandability means that users can comprehend the information within the context of the decision being made. And underlying all this has to be cost effective. So the benefit of providing information has to outweigh the cost of creating the information. Which of the following is not a component of relevance as defined in the FASB's conceptual framework? Would it be A, free from error, B, materiality, C, predictive value, D, confirmatory value? So hopefully you got that one. The correct answer is A. Free from error is only a component of faithful representation. Which of the following is not a component of faithful representation as defined by FASB's conceptual framework? Understandability. Understandability is an enhancing characteristic of decision usefulness. So now let's think about the elements of financial statements as well as some assumptions that underline financial statements. The conceptual framework defines the basic elements of financial statements. Assets are probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. Liabilities are probable future sacrifices of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. Equity, called shareholders' equity or stockholders' equity for a corporation, is the residual interest in the assets of an entity that remains after deducting its liabilities. Investments by owners increases in equity of a particular business enterprise resulting from transfers to it from other entities of something of value to obtain or increase ownership interests in it. Distributions to owners decrease equity of a particular enterprise resulting from transfers to owners. Comprehensive income is the change in equity of a business enterprise during a period from transactions and other events or circumstances from non-owner sources. It includes all changes in equity during a period except those resulting from investments by owners and distributions to owners. Revenues or inflows or other enhancements of assets of an entity or settlements of its liabilities during a period from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. Expenses are outflows or other using up of assets or incurrence of liabilities during a period from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. Gains are increases in equity from peripheral or incidental transactions of an entity. And then finally, losses represent decreases in equity arising from peripheral or incidental transactions of an entity. Now, the economic entity assumption presumes that all economic events are identified with a particular economic entity. Investors desire information about an economic entity that corresponds to their ownership interests. So if you were considering buying some ownership in Google, you'd want information on the various operating components that constitute Google. You need information not only about its United States operations, but you'd also want to know about its European and other international operations. The financial information for the various companies, subsidiaries, in which Google owns a controlling interest that's greater than 50% ownership, should be combined with that of Google, the parent company, to provide a complete picture. The parent and its subsidiaries, although they're separate legal entities, but one accounting entity. Another key aspect of this assumption is the distinction between the economic activity of owners and those of the company. For example, the economic activities of a sole proprietorship on Uncle Jim's restaurant should be separated from the activities of its owner, Uncle Jim. Uncle Jim's personal residence is not an asset of the business. Another necessary assumption is that in the absence of information to the contrary, we anticipate that a business entity will continue to operate indefinitely. Accountants realize that this going concern assumption doesn't always hold, since there are certainly many companies that fail, but this assumption is critical to many broad and specific accounting principles. So another example is this assumption provides justification for measuring many assets based on their historical cost. If it were known that an enterprise would cease operations in the very near future, assets and liabilities would be measured at their current liquidation values. Also, when we depreciate a building over a 40-year life, we assume the business is going to continue to operate that long. The periodicity assumption relates to the qualitative characteristics of timeliness. External users need periodic information to make decisions. This need for periodic information requires that the economic life of a company be divided into artificial time periods for financial reporting. Corporations whose securities are publicly traded are required to provide financial information to the SEC on a quarterly or annual basis. Financial statements often are prepared on a monthly basis for banks and others that might need more timely information. Many companies, the annual time period, the fiscal year, is the calendar year. However, other companies have chosen a fiscal year that doesn't correspond to our calendar year. So the accounting profession and the SEC advocate that companies adopt a fiscal year that corresponds to their natural business year. A natural business year is a 12-month period that ends when the business activities of a company reach their lowest point in the annual cycle. So many retailers, like Walmart, have adopted a fiscal year ending on January 31st. Business activity in January generally is slow, following a very busy Christmas period. Campbell Soup Company's fiscal year ends in July. Clorox's ends in June, and Monsanto ends in August. Now, our last assumption, the monetary unit, basically requires financial statements be measured in nominal units of money without any adjustment for changes in purchasing power. Here in the United States, the U.S. dollar is the monetary unit in financial statements. In the EU, the euro is the monetary unit. Other countries use their currency as the monetary unit. One problem with use of a monetary unit like the dollar or the euro is that it's presumed to be stable over time. The value of the dollar in terms of its ability to purchase certain goods and services is assumed to be constant over time. This assumption obviously doesn't strictly hold, though. The U.S. economy has experienced periods that are rapidly changing prices. To the extent that prices are unstable and machines, trucks, and buildings were purchased at different times, the monetary unit used to measure them isn't always the same. The effect of changing prices on financial information generally is discussed in other curriculum. Usually That type of information is handled in an advanced accounting class. Now we're going to talk about the recognition and measurement concepts that determine when elements appear in the financial statements, also at the amount at which they will appear. Recognition refers to the process of admitting information into the financial statements. When an element is recognized, it is recorded in the accounts and reported on a statement. Measurement is the process of associating numerical amounts with the elements. Disclosure refers to the process of including additional pertinent information in the financial statement and the accompanying notes. General recognition criteria is when an item should be recognized in the basic financial statements when it meets 4 criteria. Definition: the item meets the definition of an element of a financial statement. Measurability: the item has a relevant attribute measurable with sufficient reliability. Relevance is the information about it's capable of making a difference in users' decisions, and reliability is the information is representationally faithful, verifiable, and neutral. Now, there needs to be a cost-effectiveness constraint along with materiality for these items to be, in fact, recognized. Revenues are inflows of assets or settlements of liabilities resulting from providing a product or service to a customer. An income statement should report the results of these activities only for the time period specified in the financial statement. Therefore, the timing of revenue recognition is a key element of earnings measurement. Revenue recognition used to be guided by the realization principle, which requires that 2 criteria be satisfied before revenues are able to be recognized. The earning process is judged to be complete or pretty complete, and there's reasonable certainty that the money will be collected or received. The FASB recently issued ASU 09 back in 2014, which changes how we determine the timing and measurement of revenue. That standard requires that companies recognize revenue when goods or services are transferred to customers for the amount the company expects to be entitled to receive in exchange for those goods or services. Revenue gets recognized at a point in time or over a period of time, depending on when the goods or services get transferred over to the customers. Expenses are outflows or other using up of assets or incurrences of liabilities from providing goods or services. When do these expenses get realized or recognized? Expense recognition often matches the revenues and expenses that arise from the same transactions or other events. There's like a cause and effect relationship between revenue and expense recognition that's implicit in using this approach. So the net result is a measure, net income, that identifies the amount of profit or loss for the period provided by operations. Although these concepts are straightforward, it can be really tough to implement them because many expenses are not incurred directly to produce a particular amount of revenue. The association between revenue and many expenses can be indirect, so expense recognition is implemented by one of 4 different approaches, depending on the nature of this specific expense. So, based on an exact cause and effect relationship, so this approach is appropriate for cost of goods, as an example. By associating an expense with the revenue recognized in a specific time period. So, for example, the monthly salary paid to an office worker is not directly related to a specific revenue event, by a systematic and rational allocation to specific time periods. Depreciation is an example of a systematical and rational way to allocate the cost of equipment to the periods in which that equipment is used to produce revenue. Then in the period incurred without regard to related revenues. So Google spends $1 million for a series of television commercials. It's difficult to determine when, how much, or even whether additional revenues occur as a result of that particular series of ads. As indicated in SFAC 5, GAAP currently employs a mixed attribute measurement model. If you look at a balance sheet, you might see land measured at historical cost, accounts receivable are measured at net realizable value, a liability at the present value of cash payments, and an investment at fair value. There are 5 measurement attributes. Historical cost is the original transaction value that gets adjusted for depreciation or amortization, such as we use in assets. Net realizable value is the amount of cash into which an asset is expected to be converted in the ordinary course of business. Current cost would be the cost that would be incurred to purchase or to reproduce that asset. Present value is calculated by removing the time value of money from future cash flows. Oftentimes we do that with leases. Fair value is the price that would be received to sell assets or paid to transfer liability in an orderly transaction between market participants at the measurement date. So let's spend some time talking about historical cost. Historical cost bases measurement on the amount given or received in the exchange transaction, which is referred to as the original transaction value. So for an asset, historical cost equals the value of what is given in exchange, which is generally cash, for the asset at its initial acquisition. Now, liabilities, it's the current cash equivalent received in exchange for assuming the liability. Historical cost for long-lived revenue-producing assets, such as equipment, typically is adjusted subsequent to its initial measurement by recognizing depreciation or amortization. Net realizable value is where some assets are measured at their net realizable value, which is the amount of cash into which an asset is expected to be converted in the ordinary course of business. So, for example, if customers purchase goods or services on account for $10,000, and if $2,000 in bad debts would be anticipated, then net receivables would get valued at $8,000, the net realizable value. Departures from historical cost measurement such as this provide useful information to aid in the prediction of future cash flows. Companies sometimes report current costs, particularly if they operate in inflationary economies. The current cost of an asset is the cost that would be incurred to purchase or reproduce the asset. Present value is because of its importance to many accounting measurements. Present value is the focus of the FASB Concept 7, which provides a framework for using future cash flows as a basis for accounting measurement, and also asserts that the objective in valuing an asset or liability using present value is to approximate its fair value. We measure many financial assets and liabilities at fair value, which we also call current market value. Fair value is defined as the price that would be received to sell assets or paid to transfer a liability in an orderly transaction between market participants at the measurement date. A key aspect of this definition is its focus on the perspective of market participants. Let's take a look at a question here. Which of the following is not a measurement attribute defined in the FASB's conceptual framework? Net realizable value, historical cost, list price, or fair value? I hope you got that one right. List price is not a measurement attribute. It's whatever sales price a seller indicates, which can be negotiated or could also be subject to many discounts. To increase consistency and comparability in applying this definition, a hierarchy prioritizes the inputs companies should use when determining fair value. The priority is based on 3 broad preference levels, from least subjective, which is level 1, to most subjective, which is level 3. The higher the level 1's the highest, the more preferable the input. This framework encourages companies to strive to base fair values on the most objectable inputs possible. So here's another question for you. Which of the following is not true? The fair value hierarchy reflects the subjectivity of inputs used to compute fair values. B, level 1 of the fair value hierarchy refers to quoted market prices that can be directly observed. Level 3 of the fair value hierarchy refers to inputs that are not directly observable and so must be based on the entity's own assumptions. Our D, level 3 inputs are preferred to level 2, which are preferred to level 1. Well, I hope you got D is not true. Level 1 inputs are much more preferable because they're the least subjective. Level 3 inputs are the most subjective, which means they are the least preferable. GAAP gives a company the option to value some financial assets and liabilities at fair value. If a company chooses the fair value option, future changes in the fair value are reported as gains and losses in the income statement. Financial assets and liabilities are cash and other assets and liabilities that convert directly into known amounts of cash. These include investments in stocks and bonds of other entities, notes receivables and payables, bonds payable, and derivative securities. This fair value option provides companies a way to reduce volatility in reported earnings without having to comply with complex hedge accounting standards. It helps in the convergence with international accounting standards. The full disclosure principle requires that any information useful to decision makers be provided in the financial statements, subject to cost effectiveness constraint. Information can be disclosed in a variety of ways. Parenthetical comments or modifying comments which are placed on the face of the financial statements. There can be disclosure notes conveying additional insights about company operations or accounting principles, contractual agreements, and pending litigation. And then there are supplemental schedules and tables that report more detailed information than is shown in the primary financial statements. This shows you the summary of the recognition, measurement, and disclosure concepts. The role of the conceptual framework is similar in IFRS except for a couple of exceptions. In U.S. GAAP, the concept framework primarily provides guidance to standard setters to help them develop a high-quality sense of standards. But in IFRS, the conceptual framework guides standard setting, but in addition, it provides a basis for practitioners to make accounting judgments when another IFRS standard doesn't apply. IFRS emphasizes the overarching concept of the financial statements providing a fair presentation of the company. U.S. GAAP does not include a similar requirement, but U.S. auditing standards do require that consideration. GAAP continues to evolve. In particular, U.S. and international GAAP have been evolving over time from an emphasis on revenues and expenses to an emphasis on assets and liabilities. Now, we know balance sheet and income statements are intertwined and must reconcile with each other. However, which do we start with? Well, a revenue expense approach to financial reporting emphasizes recognition and measurement of revenues and expenses, with the balance sheet including items when their related revenues and expenses are included in income. An asset liability approach emphasizes recognition and measurement of assets and liabilities first, and then followed by the recognition of revenues, expenses, gains, and losses. So since 2010, we know these two agencies have worked separately on their conceptual framework. FASB's worked on narrow projects where IFRS has moved forward with more of a comprehensive overhaul on its framework. Again, the IFRS's 2015 exposure draft addressed objective and qualitative characteristics of financial reporting and definitions, when to recognize or to de-recognize assets and liabilities, measurement approaches, understanding the distinction between net income and other comprehensive net income, and then lastly, what constitutes a reporting entity. Let's take a look at exercise 1.1 in the back of this chapter. So as you see, listed below are some transactions that took place during the first 2 years of operations for the law firm of John and Steves. You see amounts billed to customer for services rendered. In year 1, we had $200,000. In year 2, we had $210,000. Then cash collected from customers. In year 1, we had $193,500. In year 2, we had $206,500. Then we had cash disbursements. We had salaries paid. In year 1, $65,000. In year 2, $75,000. Utilities, $30,000 and $50,000 respectively. And then purchases of insurance policies. Year 1, $48,000. Then it gives us some additional information. We learn that the company incurred utility cost of $40,000 in year 1, that there were no liabilities at the end of year 2, no anticipated bad debts on receivables, and that the insurance policy covers a 3-year period. So our first requirement is to calculate the net operating cash flows for year 1. Remember, this is going to be a cash basis, not accrual basis. So cash flows, we would deal with the cash collected, not the cash or the amounts billed. And then we would show for expenses the amounts that were paid out. So as you see here, in year 1, cash receipts from customers, $193,500, and in year 2, $206,500. the cash disbursements, salaries, utilities, and insurance. The end of year one, we would have a net operating cash flow of $50,500. In year two, with the $206,500 of receipts and then the disbursements for salaries of $75,000 and utilities for $50,000, we would have a net operating cash flow of $81,500. Next, we are to look at this regarding the accrual basis. So we will provide an income statement where we show the amounts billed. Then, as far as expenses go, the amounts that are incurred. The one item to be aware of in this scenario is we paid an insurance expense that will last for 3 years. So we will allocate this insurance over the 3-year period that it covers. So as you see in this example, we have net income of $79,000 for both of the years. Our net operating cash flows, you can see on a cash basis, are very different from the accrual basis. As far as the receivables go, we show the accounts receivable at the end of year one had a debit of $200,000. Well, when we received the cash from customers, we credited that receivable, so we end up with a $6,500 balance at the end of year one. At the beginning or throughout year two, we billed $210,000. We collected $206,500, which gives us an ending balance in accounts receivable at the end of year two of $10,000. Next, let's look at exercise 1-2. There are several transactions that took place during the second and third years of operations. Amounts billed to customers for services rendered, and then those collected from customers. And then we also see the various cash disbursements, payment of rent, salaries paid, travel, and advertising. Now it's important to note that the advertising costs in year two owed the advertising agency $5,200 at the end of year one, and there were no liabilities in year three. The anticipated bad debts on receivables and the rent payment was for a 2-year period for year two and year three. So we are going to calculate the accrual net income for both of these years, and then we'll talk about what liability would be shown on the balance sheet at the end of year two. So in looking at an accrual statement, again, we want to show the billings, what we earned. $381 in year two, $490 in year three. As far as the expenses go, you see the rent covered 2 years. So even though we paid it all in year one, we only take half as an expense. The other half would be sitting as a prepaid rent asset. Next, our salaries, we would show the full amounts. Our travel and entertainment would be the full amounts. And then our advertising costs would be the total amount $49,300, which basically is the $54,500 minus the amount owed at the end of year one. At the end of year, that's for year two. At the year three, it would be the $49,300 minus the $28,500 that was recorded in year two. Now, as far as advertising, let's just confirm our advertising costs of $28,500. However, the disbursements for year one, $16,500, and year two, $38,000. So if we owed the advertising agency $5,200 at the end of year one, we start with that. We show the advertising costs of the $28,500 and then what was paid to come up with the balance in advertising payable. Then we add the amount of advertising in year three along with our disbursements for what we paid out in advertising to see we show a zero balance at the end of year three. Well, there you have it for Chapter 1. I know this was very lengthy and covered a lot of concepts, but we will move on to some better things in Chapter 2.